Welcome back to the portfolio, everyone. And today we have to do a deep dive into Workhorse Stock. This is one of the electric vehicle companies that has taken the market by storm and has seen insane surges in share price over the past 6 months. This company operates, manufactures, and produces electric vans and drones, and this company is one of the hype stocks that you hear about all the time. So there's a lot of investors who really believe in Workhorse, and they really believe it will be a company that will surpass where it is right now and grow long-term into the future. So today we're going to do a deep dive into Workhorse, and we're going to take a look at what analysts are saying about the company. We're going to take a look at what the bulls are saying, what people believe the price of Workhorse will be within the next 6 to 12 months, and then take a look at a couple news headlines about Workhorse and talk about whether or not we actually believe this company can grow bigger at where it is and actually start gaining revenue and actually making some profit one day in the future. So we're going to jump into Workhorse, do a deep dive into the entire company, share with you what this company actually does, look at price targets for the company, and just go over the company financial statements and just make our own analysis and deep dive to determine if we like Workhorse right now. So everyone, as you know, I'm the Gen Z investor, and every single day on this channel, I come out with new videos that talk about different stocks you can buy, overall stock market performance, or any other big stock market news and headlines. And of course, today we have to talk about Workhorse, one of these companies that have seen insane growth over the past 6 months. If we jump over their 6-month chart, you can see they're up 390%, and I've seen an absolute surge over the past couple of months. So the share price for Workhorse is right now at around $15.14. So if you take a look at the 52-week range, they are somewhat near the middle right now. 52-week high at around $22. Meanwhile, their 52-week low is at $1.32 a share. So this price has seen insane growth over the past 52 weeks. Market cap for Workhorse right now is around $1.38 billion. And of course, this company has been in the news because of their potential for future growth. This company operates in the electric vehicle sector, which has seen a huge surge across all the major 5 electric vehicle companies. And we're going to determine if Workhorse can continue this growth. If we believe we can see this stock hitting $30 a share, $40, $50 a share sometime into the future. Workhorse has seen a very volatile price chart. Within one day, these shares have jumped over 18% in a single trading day when good news about the company came out. So if you don't really know what Workhorse is or what they actually do or produce, so they are a company that produces electrical vehicles, especially vans and drones, and what they're focusing on is that last mile delivery. So with the growing of e-commerce and our whole new world where we buy everything online in the digital world, a lot more products are being delivered to homes. So what Workhorse is focusing on is that last mile delivery from a warehouse to consumers' homes. So what they really do is they operate and they manufacture delivery vans and delivery drones. So their next generation of vehicles is an all-electric delivery van with a 100-mile range. So they have 2 models right now. Our current delivery vans are E100 and E-Gen, and they have more than 4 million miles on them. So they're actually vehicles on the road right now delivering packages. And then they also have this drone delivery service where there's a drone within each truck, and the drone actually leaves the truck with the package in a little carrier and delivers the packages to people's homes. So they are focused on that last mile. So if we take a look at their vans, these are 2 of their models right now, C650 and C1000. And essentially what they're trying to do is they're built exactly like I said for that last mile. What they're trying to do is when their packages has reached their end destination, so it is a package has come in from overseas and has landed within the final city, these are the vehicles that are going to bring that package directly to consumers' homes in an unparalleled smooth ride for delivery and load. And of course, these have a bunch of different features. Like I said, it's 100% electric vehicles. They have a low floor design to make it easier to load and get the driver on and off the truck. And of course, they also come with the unique drone feature where there's going to be a drone on top of the actual truck that will be used to deliver packages. So we take a look at the drone. You can see here, there it is. There's a little visual. It comes right out of the truck and it carries packages in this little container below it. And what it does is it drops off the packages at the doorstep or the backyard of its end destination. So Workhorse is a complete unique company. Not a lot of companies right now are operating in the way they are choosing to operate. So right now we're going to jump into some price targets to determine what analysts are saying with regard to Workhorse. So of course we've seen an insane surge in share price over the past 1 year. Their 1-year return is around 277%, which is absolutely ridiculous. So if you bought into Workhorse 52 weeks ago, you're up close to 300% on your buy. If we take a look at the 5-week chart, of course, 5 years ago, Workhorse was trading as just for pennies a share. Their share price is now up 653%. Of course, that destroys the overall market return. But of course, it's very hard to get into these companies when they're so early, especially 5 years ago. Within the past year, the shares are up 400%. if we take a look at what these analyst estimates are actually valuing, they're actually showing right now, what these analysts believe, Workhorse is actually undervalued. 54% undervalued with the current price around $15.15. Meanwhile, they believe the fair value for this company is at $33 a share. So of course, every analyst has a different way of calculating fair value, and more than one analyst you have to take a look at, because some are bulls towards companies, some are bears, some have more pessimistic versus optimistic views on each company. So that's why I like to compare different price targets from different analysts to determine what is the overall consensus. If I take a look at 10 different surveys, what's the average survey saying? Or is the average survey between all these analysts bullish, bearish, and that's how we determine. So today we're going to take a look at about 3 or 4 different price targets for the company. And you can see here the first one shows that it's actually undervalued by a significant amount. So if you were to buy in right now and they actually reach that fair value, you're going to see a 54% discount right now for the shares. Next thing we're going to take a look at is future growth. So before we jump in, later in this video, we're going to take a look at the financial statements for Workhorse. And what you're going to see right now is that they really aren't producing anything. They're losing money each and every year. They're not really generating revenue. Their balance sheet isn't the best. So what we really want to take a look at is, so you're buying this company now, you're buying it with the hopes that they're going to grow and strengthen the business into the future. You're not going to buy for value now, you're going to buy for the value in the future. So if you take a look right now, you can see this company has brought in $96,000 of revenue this year and has lost a ridiculous $26 million in earnings. They have a net loss around $26 million. But with these analysts are expectations, so of course these are bulls, they see over the next 3 to 4 years, revenue growing exponentially and the company actually becoming profitable within 2 years. And past that, they see the company actually generating significant amount of net income each and every year. So that's a good thing to see, where analysts are actually predicting future growth and future revenue for different companies. A different website, a different analyst said their price target for Workhorse is only $21.50. So even though the shares are at $15 right now, that still represents close to a 42% upside. But these analysts don't actually recommend that $33 fair value. They only see the fair value per share right now and the price target within the next 12 months to be at $21.50. Still, recommended as a strong buy with a 42% upside. That is still crazy. That's still very nice to see. And that's not even the optimistic. They have an optimistic view for $27 a share. Of course, the pessimistic or the bear view puts it at $11.50 a share. And the average view puts it at $21.50. So overall, another 40% upside with regard to price target for the next 12 months from a different group of analysts. And if we jump over one more time to a third report from third different analysts, this is a different set of analysts once again, you can see here, they have a similar price target, almost identical at $21.50 per share. They have a high at 27 and a low of $11.50. This article right here is from a different source who may take into consideration different analysts who still believe that Workhorse's current share price is below where they expect it to be within the next 12 months. So of course, with all analyst expectations, they use formulas, they use different algorithms to determine where the share price may be, but it's still all guesses. No one has a crystal ball. No one knows for sure where the share price will be. So you have to keep that in mind when evaluating companies. Don't only believe just because analysts say the price is going to go up, that actually will. But it is a good expectation to kind of follow, just to understand people who may be more intelligent than you, may know more about the market than you. If they believe this company may be going up, then that is a little thing to keep in mind. If all these analysts said this company is going to go to zero and you really were on the fence, maybe you could take that into consideration. That might sway your decision to stay away. But as of right now, price targets within the next 12 months are actually looking not too bad for Workhorse. If we move over to now some big news for the company, is they actually received an order for 20 of their vehicles. So of course this company isn't really generating much revenue right now. So once we get companies that are coming in and actually purchasing their vehicles from them, and we see more of that in the news, more revenue coming to the company, more earning potential, that's good signs for investors. So this week, they actually got an order for 20 of their C1000 all-electric delivery vans from a Cincinnati-based company. So that's a good sign that now we have an initial purchase. So maybe they'll purchase more into the future. If Workhorse can deliver these 20 vehicles and the company is proud and actually satisfied with the purchase, they may come back with another order for 20, 40, 50 vehicles long into the future. So it's very nice to see the news that they're actually beginning to sell their products to different companies across the United States, which is exactly what you want to see from these growth companies. Another big headline is that there are rumors that Walmart could actually acquire Workhorse and of course another company, UPS, to help compete against Amazon. So this type of delivery service, Walmart announced Walmart Plus, which is going to kind of ensure if you pay the yearly fee, next day delivery or same day delivery for a bunch of grocery and other products from their warehouses, from their stores. So that's exactly what Amazon Prime is doing right now. And Walmart Plus is a direct competitor to Amazon Prime. So it's rumored that Walmart might acquire Workhorse or look to partner with a company like Workhorse in order to have that infrastructure in order to deliver those products within the same day or next day. So Workhorse is the exact type of company that's built to do just that because they're focused on that last mile delivery. They're not the type of company that's going to deliver Walmart products across the country for thousands of miles. They're the company that is when Walmart sets up a localized warehouse within one major city, they're the company that's going to take the inventory from that warehouse and bring it to all the homes within those cities, within the local area. Especially now with the use of drones and the potential for drone delivery to only grow, Workhorse may be the company that Walmart would either like to acquire or partner with long into the future. So these rumors do really help share price and help the company, investors have strong beliefs in the company, because if the largest retailer in the world, Walmart, says they see some potential in Workhorse, that must mean that there might be something there and their products and their services may have some nice potential for the future. We're going to jump into the financial statements. You have to take a look at these. I understand this company is growing and they really have nothing fancy on these financial statements, but it's always important to take a look and do a quick analysis to determine what you're really getting into. You can't just buy off headlines. You have to buy off company fundamentals, and the fundamentals are what help you determine if you believe there's future growth later on. So if we take a look at the past 12 months, this company has generated almost next to zero revenue. Less than $100,000 of revenue within the past 12 months. A couple years ago, they brought in $10 million worth of revenue. And one thing that is a little of a red flag for me is that 5 years ago for this company in 2015, they brought in the same amount of revenue as they did in the past 12 months. So over the last 5 years, of course, the company has been growing operations and developing better products and services. But with regard to revenue, they're at the same place as they were 5 years ago. So to me, that's a little bit of a red flag. Of course, we like companies who are growing revenue. Even young growth companies like this who may not be profitable just yet, we like the trend where they're growing revenue, just so it shows that one day when they continue this trend of growing revenue, they can maybe produce profitability somewhat in the future. But with this decline in revenue we've seen over the past couple of years, that's a little bit of a red flag for me right now. We take a look at net income. Of course, this company is not really generating any profit at all. Over the past 5 years, they're losing a lot more money than they're bringing in. So you see here in the past 12 months, they've brought in less than $100,000 worth of revenue, but they've had a net loss of around $26 million. So they're posting big net losses in comparison to how much revenue they're actually bringing in. And of course, you see the trend, all net losses over the past 5 years, which is not good to see. So now we're jumping into the balance sheet. So the last financial statement we're going to take a look at, we're not going to take a look at the cash flow statement today, only because they don't really have many cash flows. Their business is selling shares to generate income and cash in order to grow the business, but they aren't really bringing any cash in from their operations. So there's no need to do a deep dive on the cash flow statement right now. If you take a look at total current assets, they have around $24 million in total current assets. Meanwhile, they have total current liabilities of $39 million. So they have a current ratio below 1. They have a lot more total current liabilities than they do total current assets, which means they have to generate cash in order to pay off these liabilities within the next 12 months. They don't have enough assets on hand within the short term to pay off their short-term debt. So what that essentially means is they're going to have to take on more financing, or they're going to have to take on sell more shares to the public to get cash in order to pay off this debt. So of course, that's not a good sign. Once again, we like current ratios at least above 1, just so it shows the companies do have the assets on hand right now to pay off that short-term debt. But Workhorse isn't there right now, which is a little bit of a red flag. And of course, you see their total assets around $44 million, meanwhile they have total liabilities around $66 million. So more liabilities than overall assets, which is again, not a good sign. So hopefully if you are a person that believes in Workhorse, they should really got to try to beef up their balance sheet and their income statement in order to, make investors maybe feel a little more safe throwing their money into this company. And of course, when there's more liabilities than assets, you can see they have total equity that is negative right now. Nothing too shocking right there. So overall, that was a quick analysis on Workhorse. We understand what this company does. They're focused on that last mile delivery. They're focused on getting products from a warehouse to consumers' home. They're doing it through electrical vehicles and vans. And of course, they have that unique drone service that comes straight out of the van that, may deliver products maybe to people's back doors, front doors, whatever it may be. And that's the new innovative way Workhorse is trying to grow their market share within the delivery space. And of course, this share price has seen insane growth, up close to 400% over the past 6 months. So if you're interested in getting into the electric vehicle market, if you're interested in buying one of these so-called hype EV companies, Workhorse may be the one for you. Always do your own research before investing. I will see you in tomorrow's video. Please like and subscribe. Thank you for watching.